Most people go through life believing their money is permanent. They trust the numbers glowing on their banking app. They trust the currency in their wallet. They trust the promises of institutions older than their grandparents. But history tells a different story, a far darker story. Civilizations rise on money, and they fall when that money dies. Not gradually, not gently, but suddenly, without mercy, leaving ordinary people stunned at how quickly everything they worked for turned into dust. Imagine waking up one morning and discovering that the savings you spent a lifetime building no longer buy a week of food. Imagine salaries turning meaningless between one sunrise and the next. Imagine banks locking their doors and telling you your own money no longer belongs to you. That horror is not fiction. It has happened again and again. Rome lived it. Byzantium lived it. Medieval Florence lived it. The Confederacy lived it. France lived it. Thailand, Indonesia, South Korea, Lebanon, they all lived it. And every time, people said the same thing the week before the collapse. This could never happen here, but it always can. Because money isn't metal, or paper, or numbers. It is belief. And belief breaks faster than bone. So, the real question isn't how strong your currency seems today. The real question is, what survives when it dies? What keeps its value when governments panic? When banks fail? When paper evaporates? When systems you trusted reveal how fragile they always were? History answers that question with brutal clarity. And if you listen closely, you'll hear another message beneath it. Collapse doesn't just destroy. It creates openings for those prepared to step through. Every collapse begins with confidence. Ordinary people look at their currency, their banks, their institutions, and they assume these structures are immovable. We grow up believing stability is the natural state of the world. But stability is the exception. Fragility is the rule. And the people of Rome, centuries ago, believed the same lie we tell ourselves today. In imperial Rome, money meant the silver denarius. It was so trusted that soldiers accepted it across 3 continents. For generations, emperors paid armies, funded roads, and maintained a global empire with this single coin. But trust is a glass ceiling. It looks solid until one crack spreads through the whole surface. And Rome's crack began with a familiar temptation: debasement. The empire was large. Soldiers demanded pay. Wars drained the treasury. Rather than raise taxes or admit weakness, emperors shaved the purity of the denarius again and again. A sliver less silver here, a sliver less there. Citizens barely noticed. The coin looked the same, felt the same, weighed the same. The lie worked until it didn't. Within a century, the denarius had become a shadow of itself. Prices soared. Merchants refused the coin. Soldiers rioted for real payment. Farmers demanded goods instead of currency. The empire had wealth, land, food, metal, but the money linking it all had been hollowed out. And once trust breaks, it doesn't return. Rome's fall didn't start with a barbarian invasion. It started with a coin that no longer carried meaning. And here is the part history whispers to anyone who listens. The collapse didn't punish those who held real value, grain, gold, land. It punished those who trusted the paper promise of an emperor they'd never meet. The illusion of safety is always the first casualty. For 1,000 years after Rome fell, Byzantium stood as the last torch of the ancient world. While kingdoms rose and vanished beyond its borders, Constantinople glowed like a fortress of certainty. Merchants from Venice, Cairo, Baghdad, and Kiev carried one coin above all others in their purses: the Byzantine solidus. For centuries, that coin never changed. Same weight, same purity, same unmistakable glow of true gold. In a world shaken by war, famine, and plague, the solidus became the closest thing to eternal money. It was accepted in ports where no emperor's law reached, trusted by sailors who had never seen Constantinople. For generations, it anchored entire economies. But no empire is immune to temptation. The Byzantines knew Rome had destroyed itself by corrupting its currency. Yet when pressure came, invasion at the borders, shrinking tax revenue, rising military cost, they repeated the same mistake. It began quietly, as these things always do. A small reduction in purity, a little alloy mixed in, a subtle dilution hidden behind the same familiar stamp. At first, nobody protested. The solidus still looked like gold. People still believed. Then came the moment. Every collapse has the moment confidence wavers. Merchants tested the coins. Word spread. Trust thinned. A currency that had ruled the Mediterranean for centuries no longer commanded respect. And when belief dies, money dies with it. Trade shrank. Prices climbed. Foreign merchants demanded silver or real gold. The empire that had held the world's most stable currency now stood exposed. But here's what mattered most. The people who survived were not the ones who clung to the emperor's money. It was the traders who quietly stocked real metal. The families who owned land beyond the reach of imperial decrees. The ones who stepped away from official promises before the crowd realized those promises were empty. Byzantium didn't fall in a day. It fell the moment its money stopped being trusted. When the plague ships drifted into Europe in the mid-14th century, no one knew the continent was about to be rewritten. The Black Death arrived quietly, a few fevers, a few corpses, then it tore across borders faster than armies, faster than news, faster than prayer. By the time it burned through the continent, as many as half of all Europeans were gone. Cities emptied, workshops fell silent. Entire villages disappeared so completely that their names survive only in church records. The devastation was beyond anything people had imagined. Yet inside the tragedy was a brutal economic truth no one saw coming. When half the workforce dies, labor becomes more valuable than gold. Before the plague, land was everything. Landowners controlled power. Peasants scraped by at the mercy of nobles who could replace them with a word. But when the population collapsed, the world flipped. Suddenly, there weren't enough hands to harvest fields or run mills. Survivors, for the first time in generations, could choose where to work and, more importantly, could refuse. Wages surged. Rents fell. Land that once required a lifetime of savings became attainable for families who had never dreamed of owning anything. A young farmer who buried half his village might, months later, buy the very fields his ancestors had worked for centuries. Liquidity, whether silver, stored grain, or simply the strength to work, became power. It sounds distant until you remember what happened during COVID. Shelves empty, supply chains snapping, governments printing oceans of cash. And those with reserves? They bought homes, stocks, businesses, everything others were forced to give up. The pattern is unmistakable. Pandemics don't just take lives. They rearrange wealth. The plague punished the unprepared, but it handed opportunity, brutal, sudden, and historic, to anyone who had even a little margin when the world froze. Before Wall Street, before London finance, before global banks existed, there was Florence. In the 1340s, it was the financial heart of Europe, a city where money moved across borders faster than armies and kings bowed to bankers. The Bardi, the Peruzzi, the Acciaiuoli. Names that carried the same weight then as J.P. Morgan or Goldman Sachs does today. Their branches stretched across Europe. Their ledgers financed wars, trade, and kingdoms. And to the ordinary Florentine citizen, they seemed untouchable, permanent, stable, safe. But strength on paper is not the same as strength in a crisis. When King Edward III of England decided he could no longer repay the loans he had taken to fund his war with France, everything unraveled. The king defaulted. Then the loans collapsed. Then the banks collapsed with them. Florentines woke up to a nightmare they didn't even have the vocabulary for. Depositors ran to the banks, only to discover the truth. Their gold was gone, their savings wiped out, their trust shattered. A city that had once felt invincible was suddenly begging for stability it could no longer manufacture. Sound familiar? It's the same story told centuries later by Lehman Brothers in 2008. and again by the banks of Lebanon in 2019, when accounts were frozen and salaries became meaningless overnight. But the lesson didn't start in the modern world, it started right there in Renaissance Florence. Too big to fail has always been an illusion. The people who survived that crash weren't the ones who trusted the system most. They were the ones who kept assets outside those banks, merchants with goods stored abroad, families with land instead of ledgers, traders with connections beyond the Florentine walls. The city recovered eventually. But those wiped out? They never saw restitution. Because once a giant falls, it doesn't fall on its own. It falls on everyone standing beneath it. Most Americans learn about the Civil War through battles, generals, and turning points. But almost no one learns about the financial collapse that unfolded quietly in the background. A collapse so extreme that it destroyed the currency of an entire nation. While the Union fought to preserve the country, it fought a second battle at home. The battle to fund a war too large for gold reserves to support. So Washington printed paper money greenbacks. At first, they felt patriotic, a bold experiment, a promise backed by the government itself. But paper issued without restraint becomes its own enemy. As more greenbacks flooded the economy, their buying power drained away. What bought a basket of goods one month couldn't buy a loaf of bread the next. Soldiers, factory workers, and farmers watched their wages shrink in real time. The ink was still drying on many notes before inflation devoured their value. And if life in the North was painful, life in the Confederacy was financial freefall. Desperate for resources, the South printed even more aggressively, graybacks that collapsed into absurdity. By war's end, prices had risen thousands of %. Merchants wouldn't trade paper for food. Families carried sacks of money worth less than kindling. A soldier could be paid in the morning and be unable to feed his family by nightfall. The Confederacy's currency didn't decline slowly. It died. And when it died, it took fortunes, savings, and entire livelihoods with it. The only people who emerged from that collapse with anything were the ones who held real value: land, livestock, gold, food. Tangible goods the printing press couldn't dilute. It's a chapter Americans rarely discuss, but its warning is unmistakable. Your nation's money can fail within your lifetime. And when it does, the paper in your pocket becomes a relic, not protection. Revolutions promise renewal. But in 18th century France, the revolutionaries discovered a truth older than any monarchy. You cannot print stability. When the French Revolution erupted in the 1790s, the new government seized vast amounts of church land, monasteries, estates, fields, vineyards. To turn that land into money, they issued a new currency, the assignat. Each note was backed, in theory, by confiscated property. It sounded clever, reasonable, even modern. But theory collapses fast when politics enters the printing press. Once the first notes circulated successfully, the temptation became irresistible. Why stop at one issuance? Why not print more to cover debts, pay soldiers, subsidize bread, fund the revolution? And so they printed, and printed, and printed. Every new assignat weakened the last. Prices rose, wages froze, and the beautiful promises of equality dissolved into economic chaos. What began as a currency backed by land became a currency backed by nothing at all, just hope and ideology. Soon, farmers refused to sell grain for paper. Bakers demanded silver or goods, not patriotic notes. Markets emptied, bread riots returned. Paris starved while the printing presses thundered. The collapse wasn't slow, it was violent. By the mid-1790s, the assignat was worthless. Entire fortunes evaporated. Pensioners were ruined. Middle-class families who had trusted the new government discovered once again that trust is not wealth and paper is not security. But some survived. Not because they believed, but because they doubted early. Those who quietly stored silver, gold, farmland, or physical goods held purchasing power, while their neighbors watched their savings dissolve. In a revolution built on equality, the currency collapse created a new inequality between those who prepared and those who believed the promises. History's verdict was brutal. The revolution changed laws. It changed rulers. But it could not change economics. No government can print value. It can only print paper. In the summer of 1997, the world learned how quickly confidence can turn into catastrophe, and how a single broken promise can ignite an entire region. It began quietly in Thailand. For years, the Thai government had borrowed heavily in US dollars, trusting that its currency, the baht, would stay firmly pegged to the American dollar. As long as the peg held, everything worked. Loans were cheap. Growth was rapid. Foreign investors poured in. But debt in someone else's currency is a blade disguised as opportunity. The moment the peg cracked, the blade turned. When Thailand finally abandoned the peg under mounting pressure, the baht collapsed in a single breath. Overnight, every dollar-denominated loan doubled or tripled in cost. Debt that looked manageable on Monday became impossible by Thursday. Investors fled. Capital evaporated. Panic spread like dry brush catching flame. And the fire did not stop at Thailand. Indonesia's rupiah fell. South Korea's won fell. Malaysia's ringgit fell. A chain reaction, ruthless and mechanical. Businesses that had been profitable weeks earlier were suddenly insolvent. Families who had saved for decades saw the value of those savings sliced to a fraction. Workers lost jobs not because they failed, but because the financial architecture around them collapsed. Governments scrambled to the International Monetary Fund for rescue, but rescue came with demands: austerity, spending cuts, higher interest rates, medicine that tasted like poison to ordinary citizens. And yet, while millions struggled, a familiar pattern reappeared. Those who held US dollars, foreign assets, or international accounts endured the storm. Those who trusted only their local currency were left exposed as the floor crumbled beneath them. Global hedge funds, the very actors many blamed for sparking the crisis, returned later to buy Asian assets at fire sale prices. What looked like a regional tragedy was, beneath the surface, one of history's largest quiet transfers of wealth. The lesson from 1997 echoes Byzantium, echoes France, echoes every collapse. The danger isn't debt. It's debt in someone else's money. Because when confidence breaks, the creditor survives. The debtor drowns. In 2019, the world witnessed one of the most brutal modern financial implosions. Not in a distant empire, not in a war zone, but in a country where ordinary people believed their money was safe behind glass counters and marble floors. Lebanon's banking system was once praised as the Switzerland of the Middle East, a place where savers felt protected and the currency felt stable. Then, one morning, the doors didn't open. Without warning, banks froze withdrawals. ATMs stopped working. Transfers abroad were blocked. People lined up outside branches, holding passbooks, passports, documents, anything that proved the money was theirs. None of it mattered. Inside the banks, the screens showed balances that were now nothing more than numbers without value. Outside the banks, people's faces showed shock that would soon turn into rage. The Lebanese pound disintegrated. Not slowly, violently. It lost more than 90% of its value. Savings that could once buy a home could now barely buy bread. Doctors, engineers, teachers, entire middle-class families were wiped out in a single season. Retirement plans evaporated. College funds vanished. Businesses folded. A lifetime of effort dissolved into nothing the moment trust collapsed. And yet, in the middle of this nightmare, a painful pattern appeared once again. Those who had quietly stored US dollars outside the banking system could still function. Those who held physical gold could still trade. Those who owned real assets, property, land, goods, could survive the chaos. Everyone else was trapped in a cage they never saw being built. It didn't matter how hard they worked. It didn't matter how loyal they were. It only mattered where their wealth was held, inside a system collapsing, or outside it. Lebanon wasn't a unique tragedy. It was a modern reminder of the oldest rule in financial history. Your bank balance is not a guarantee. It is a promise, one that can be broken. When money collapses, it doesn't ask who worked hardest. It doesn't spare the loyal or reward the patient. It simply disappears, taking with it the illusions people trusted their whole lives. But history could not be clearer about one thing. Collapse is not the end. It is the dividing line between those who relied on promises and those who prepared for reality. Across 2,000 years, from Rome to France, from Florence to Lebanon, the pattern has never changed. When currencies fail, when banks freeze, when governments dilute their money until it loses meaning, survival belongs to the same groups every time. Those who hold real value. Those who stay liquid when others stretch themselves thin. Those who refuse to believe that this time is different. Empires crumble. Institutions panic. Politicians improvise. But land still feeds families. Gold still trades in every corner of the world. Goods still matter. Skills still matter. The ability to produce anything remains priceless when paper money loses its voice. That is the truth history keeps whispering. Century after century. Prosperity is not guaranteed, but collapse is predictable. And those who rise from it are never the ones who waited for rescue. They are the ones who built their own lifeboats long before the waves arrived. So here's the decision every viewer faces. You can trust the system that has failed countless civilizations before ours. Or you can learn from the few who walked out of history's darkest chapters not poorer, but stronger. If this episode gave you clarity, if it showed you why collapse is not a fantasy but a cycle, subscribe. Because what we cover next will prepare you in ways most people will never expect. History doesn't repeat, but it warns. And if you know how to read it, you won't just survive the next crisis. You'll survive it with something real still in your hands.